Welcome to Griffonomics. Today we're diving into the trade desk, trading under the ticker TTD.
And this is a pretty intense one for you listening today.
It really is. I mean, imagine writing a personal check for like $148 million.
Just deploying your own capital on the open market.
Right, exactly. Buying stock in your own company because you are absolutely convinced that Wall Street is just completely mispricing your life's work.
Yeah, it's a massive flex.
But then imagine watching that exact investment lose almost half of its value in just a matter of months.
Oh, it's brutal. But I mean, that is the literal reality for the CEO of the company we're dissecting right now.
Yeah, it is. Because TTD is navigating this dramatic growth stall along with a massive valuation derating. I mean, they just posted their second quarter 2026 revenue at $715.1 million.
Which is up just 3% year over year.
3%. And then they issue this highly cautious third quarter revenue guide of, quote, at least $650 million.
Right. And if you do the underlying math there, that implies a 12% top-line contraction.
Which is jarring. I mean, you are no longer talking about just slowing growth, right? You're talking about a shrinking revenue base.
You are. But, and this is the core paradox for you to think about, that operational deceleration is colliding with a pristine fundamental floor.
Exactly.
Because beneath that stalling growth rate, their balance sheet is just a fortress. I mean, they hold $1.49 billion in total cash and marketable securities.
With absolutely zero debt, which is wild for a tech company of this scale.
Zero debt. And furthermore, their customer retention remains at 95% plus. Plus, the enterprise value has compressed to under 6 times adjusted EBITDA.
Okay, well, let's unpack this. Because our mission for this deep dive is to basically forensically audit what exactly broke in the hypergrowth thesis here.
Yeah, we really need to get into the mechanical variables behind that top-line miss.
Right, and determine whether this is, a broken company or actually a massive turnaround opportunity for the value investor.
Well, the initial instinct when you see a high multiple tech stock suddenly contract like this is to just assume the core product lost its utility, right?
Yeah, that's what Wall Street assumes immediately.
Exactly. But that $715.1 million revenue print, which, by the way, missed the $751.4 million consensus expectation.
Roughly $36 million, yeah.
Right. It requires a much more granular autopsy than just saying the product failed. You really have to isolate the macro headwinds dragging down the gross platform spend.
And there are two specific verticals causing the bulk of this drag, right? Automotive and consumer packaged goods.
Yeah, auto and CPG. And combined, those two account for roughly 25% of the total gross spend flowing through TTD's pipes.
So let's talk about the mechanics of that drag. Why those two sectors specifically? I mean, what is happening there?
Well, both the auto industry and the CPG sector are highly sensitive to this phenomenon of consumer wealth bifurcation.
Okay, break that down for me.
So it's being exacerbated by tariffs and commodity inflation. You basically have high-income earners driving the bulk of discretionary and premium sales, right?
Right.
While lower-income earners are just intensely squeezed by sticky inflation. And that completely disrupts how Fortune 500 giants go to market.
Oh, I see. Like, take Ford and General Motors, for example.
Exactly. Their earnings materials explicitly highlight a growing dependence on affluent consumers.
Because the data shows that earners in the top 20% of households currently represent like more than 50% of new vehicle sales?
Yeah, and GM also pointed out a multi-billion-dollar impact from tariffs, which is forcing them to completely rethink their supply chain.
And then on the CPG side, you have Procter & Gamble explicitly citing continued pressure from commodity costs and geopolitical volatility in the Middle East.
Right. So if your input costs are skyrocketing and your median consumer is financially exhausted, your advertising strategy has to fundamentally shift.
It has to.
Yeah.
And that shift is precisely what broke the trade desk's growth algorithm this quarter.
Because major advertisers didn't pull their budgets entirely, which, again, is why retention remains above 95%.
Right. They didn't leave the platform.
No, they didn't leave. They just radically altered their buying mechanics.
Yeah, so instead of utilizing TTD's highly sophisticated value-based AI decisioning, where it evaluates 20 million ad opportunities per second.
And dynamically prices each impression based on projected return, yeah.
Exactly. Instead of doing all that, they retreated into what the industry calls programmatic guaranteed alternatives.
Which is such a fascinating shift because programmatic guaranteed sounds like a positive term on the
It
surface.
does. It sounds super premium.
But it's actually a massive downgrade in sophistication.
Let's drill into the mechanical difference there.
Yeah.
Because I like to think about it like a corporate client suddenly downgrading from this custom a la carte fine dining experience to a fixed price, low-quality buffet.
That's a perfect analogy.
Right. Just to keep costs predictable. Because the trade desk's primary engine, their real-time bidding infrastructure, is built to give the buyer absolute control.
You bid based on the exact value of the user at that exact millisecond.
Yes, but when budgets get tight, CFOs panic. They demand cost certainty above all else.
So they downgraded to programmatic guaranteed. They just lock in a fixed CPM with the publisher up front.
They completely surrender their pricing power and their targeting agility just to ensure their budget doesn't fluctuate.
They are literally prioritizing predictable mediocrity over dynamic optimization.
Which is wild. But that is the core mechanical issue driving the top-line miss.
Yeah, in a programmatic guaranteed deal, the buyer essentially bypasses the AI. They're bypassing the very algorithmic decisioning that justifies TTD's take rate in the first place.
Right, so the plumbing is still connected, but the volume and the complexity of the data flowing through those pipes is severely diminished.
Exactly. The advertiser is prioritizing a known fixed cost of transaction because their own margins are under siege from those tariffs and inflation we talked about.
Okay, so I understand the domestic contraction. But looking at the data, this seems to be a uniquely American hesitation, right?
It really is. The international numbers paint a completely different picture.
I mean, the ENA region, Europe, Middle East, and Africa, alongside the APAC region, they expanded nearly 30% year to date.
And China grew over 100%.
Right. And connected TV, or CTV, grew over 50% year over year in both EMEA and APAC.
Which is a critical data point for you to consider. Historically, regions like APAC have been overwhelmingly mobile-first markets.
Yeah, they skipped the desktop era almost entirely.
Exactly. So seeing connected TV explode by over 50% in those territories indicates that TTD's infrastructure investments abroad are finally reaching critical mass.
Advertisers in those regions are finally adopting the programmatic CTV model that matured in the U.S. a few years ago.
But here's the catch. Because the U.S. market still represents roughly 83% of total revenue,
Right.
that massive international growth is mathematically overshadowed by the domestic stall in auto and CPG.
Right, so if 25% of the business is stalling domestically, the international breakout just isn't big enough yet to carry the weight.
Exactly. It's a tale of two markets. But the revenue miss is really only half the crisis here.
Right, because if we look at the profitability metrics, the bottom line is arguably bleeding even more than the top.
Oh, for sure. I mean, we saw a severe 527 basis point year-over-year contraction in their adjusted EBITDA margin.
Dropping it down to 33.7%.
And correspondingly, JAP operating income plunged to $101.6 million.
So where exactly is the cash bleeding out?
Well, the hemorrhage is highly concentrated in platform operations.
Right.
We saw a 22.1% surge in platform operations costs.
Bringing that line item to $184.3 million for the quarter.
Yeah. And when you unpack that surge, it basically splits into two distinct mechanical drivers. First, there was an $18 million increase in third-party data and supplier components.
10 seconds.
Second, there was an $8 million increase in hosting expenses.
Okay, so the $18 million increase in third-party data components, that's tied to how they are recognizing revenue for value-added services, right?
Yeah, they're shifting costs that used to be netted against revenue directly into direct operating expenses.
But that $8 million increase in hosting expenses, that is purely structural. That is the literal cost of computing.
It is the cost of migrating the computational burden. TTD is actively transitioning critical workloads away from third-party public cloud providers.
Like AWS or Google Cloud.
Right, and they're migrating them into their own custom-built data centers. They are purchasing the bare metal servers required to support these complex machine learning workloads.
Okay, we really need to explain the physics of this transition for the listener.
Yeah, it's fascinating.
Because when you are processing 20 million ad opportunities per second, you are dealing with latency requirements measured in single-digit milliseconds.
You absolutely cannot rely on a generic public cloud instance for that.
You can't. Because the transit time, the literal speed of light across fiber optic cables from an exchange to a public server and back, creates a bottleneck.
Right. So by building their own data centers and positioning their servers directly adjacent to the major internet exchanges, they minimize that latency.
But the upfront capital expenditure is just punishing.
Oh, it's a massive upfront cash burn. You're buying physical hardware, setting up the cooling, the power, the networking.
Rather than just renting server space on demand.
Exactly. But the thesis is that once the hardware is deployed, the marginal cost of processing the next billion bids drops exponentially compared to paying a public cloud provider's markup.
So the operating leverage materializes eventually,
Mm.
but right now it's just devastating the current quarter's margins.
And what's fascinating here is the accounting maneuver the company executed to sort of soften that blow.
Oh yeah, the depreciation change.
Right. Effective April 1st, 2026, the trade desk enacted a prospective change in an accounting estimate. They extended the estimated useful life of their data center servers from 3 years to 4 years.
Let's dig into the GAAP mechanics of that decision. Because the server is a physical asset, right?
Yeah.
And under accrual accounting, you don't expense the entire cost of the server the day you buy it. You capitalize it on the balance sheet and expense it gradually over its useful life through depreciation.
Right. So by suddenly declaring that these servers will last 48 months instead of 36, you are taking that same asset cost and spreading it over a longer horizon.
And the immediate result is a reduction in your quarterly depreciation expense.
Mechanically, this accounting estimate change reduced their quarterly platform depreciation expense by $4.6 million.
And because depreciation is an expense that reduces taxable income, lowering it directly inflates the bottom line.
Exactly. That $4.6 million reduction added $3.1 million to their net income.
Which subsequently added exactly 1 penny to their diluted earnings per share.
They literally manufactured a penny of EPS by tweaking a spreadsheet assumption regarding the physical degradation of their servers.
Now, is it compliant? Absolutely. If the engineering team determines that the hardware refresh cycles can actually be extended, JAP requires you to update the useful life estimate.
Yeah, it's totally legal. But as an investor auditing a growth stall, you really have to mentally back out that penny to understand the true operational pressure.
Because the margin compression would have been even steeper without that adjustment.
Over the full year 2026, this change is projected to save them roughly $14 million in depreciation expense.
Wow. And while depreciation is a non-cash expense, there is a very real, highly dilutive expense burying the income statement right now.
Stock-based compensation.
Stock-based compensation. In Q2 alone, SBC ran to $109.6 million.
And the sources detail a staggering $1.01 billion in unrecognized stock compensation waiting to hit the income statement in future quarters.
$1 billion.
Yeah, consisting of $808 million in restricted stock units and $185 million in options.
That is just a billion-dollar anvil hanging over the equity.
Yeah.
Now, the defense you often hear is that SBC aligns employee incentives with shareholders and preserves cash.
Right, and we did see general and administrative expenses fall 12.9% year over year.
But that decline was mostly an optical illusion, wasn't it?
It was, because a massive 2021 long-term CEO performance option grant was fully recognized as of March 2026.
Meaning they had zero expense for it in Q2 compared to a $19 million hit the prior year.
Exactly. So the underlying SBC run rate actually remains incredibly high.
And that high SBC run rate collided violently with the collapse in the stock price, which triggered a severe tax consequence.
Yeah, they reported an elevated effective tax rate of 43.1% for the quarter.
A corporate tax rate sitting above 40% immediately signals an anomaly in the tax provision logic.
And the anomaly here is the equity tax detriment. This is where the mechanics of employee compensation intersect with the IRS code.
Okay, explain how that works.
When a company grants a restricted stock unit, they estimate its value and expense it. When that RSU actually vests and the employee takes ownership, the company is entitled to a tax deduction based on the market value of the stock on the day it vests.
Right, but the structural risk of that mechanism is your exposure to the share price.
Exactly, because if you grant an employee stock when it is trading at $50, you're modeling a certain tax deduction.
But if the stock collapses to $13.40 by the time it vests,
The actual tax deduction the company is legally allowed to take is drastically smaller than the expense they previously recorded.
which creates a shortfall, a tax detriment. You essentially lose a massive tax shield because your equity lost its value.
And in Q2, TTD recognized $9 million in tax detriments directly related to the vesting and exercising of underwater employee equity awards.
So the company is hit twice. The stock price crashes, hurting the enterprise value, and because the stock crashed, their tax bill mathematically surges, compressing net income even further.
It creates this compounding cycle of margin degradation.
Yeah, you have auto and CPG advertisers retreating to fixed-price programmatic guaranteed deals, suppressing top-line revenue.
You have massive capital expenditures required to migrate workloads to own data centers, inflating platform ops costs.
You have $1 billion of unrecognized SBC waiting to dilute the float.
And you have tax detriments punishing the effective tax rate. The friction is systemic.
It really is. Which means management cannot just wait for the macroeconomic weather to clear, right? They have to structurally overhaul the product to force adoption.
Right. And CEO Jeff Green openly admitted on the earnings call that internal execution missteps actually compounded the macro pain.
He specifically pointed to severe client friction and workflow complexity within their existing platform interface, which is known as COCI.
Yeah. If your interface is a labyrinth, an exhausted media buyer at a major agency is simply going to take the path of least resistance.
They will absolutely abandon the complex value-based bidding tools and just default to the simplest fixed-price option available.
Which is programmatic guaranteed. So the operational response to that internal friction is the late August 2026 launch of Zuma.
Zuma. This is a comprehensive usability overhaul designed to fundamentally simplify the navigation architecture, right?
Yes. The entire mandate is to improve the human-machine UI dialogue. Enterprise ad tech platforms often suffer from feature bloat.
Oh, tell me about it. They add so many dials and levers that the human operator just becomes paralyzed.
Exactly. So Zuma is engineered to abstract that complexity, allowing the AI to handle the micro-bidding while the human operator focuses purely on high-level strategic inputs.
A streamlined interface is critical for adoption. But here's where it gets really interesting. They are not just redesigning the buttons.
No, they are completely dismantling the commercial mechanics of how advertisers purchase data.
They're launching a framework called Audience Unlimited. And this is fundamentally the Spotify for data.
Yeah, and to understand why this is revolutionary, you have to understand the legacy data supply chain.
Right. Historically, if you're an advertiser targeting a specific cohort, let's say you want to reach households with a dual income over $150,000 who have shown intent to purchase a luxury SUV.
Very specific.
Very specific. You have to buy third-party data segments from various brokers, and the data management platforms, the DMPs, they operate like toll booths.
Every time you layer a new data parameter onto your target audience, the DMP charges a per-segment markup.
And that per-segment markup acts as a punitive tax on sophistication.
It actively discourages media buyers from utilizing multiple data sets because every additional layer mathematically degrades your eventual return on ad spend.
You are paying a premium just to filter the audience before you even pay for the ad impression itself. It's crazy.
Exactly. So Audience Unlimited obliterates that fragmented tax structure. It introduces an all-you-can-eat subscription pricing model.
An advertiser pays a flat fee, and the per-segment markups are entirely eliminated.
You have total access to the deterministic data ecosystem without the friction of microtransactions.
Which incentivizes the buyer to use as much data as possible to refine the targeting, because the marginal cost of adding another data layer is now zero.
And the preliminary metrics from the beta deployments completely validate the architecture.
Yeah, by removing the per-segment tax, advertisers reported that their client data CPMs, the cost per 1,000 impressions, related specifically to data targeting.
And their cost per unique household.
Right, both dropped by more than 25%.
Lowering the underlying cost of data acquisition inherently increases the operational efficiency of the total campaign budget.
But lowering the cost of data is really only half the equation, right? If you target the perfect households at a 25% discount, you still have to prove to the CFO that the ad actually caused a sale.
Right, attribution. And the legacy mechanism for proving that last-click attribution is failing spectacularly in the modern media environment.
It's terrible, because legacy attribution models were built for a desktop-first open web environment. They assign 100% of the conversion credit to the final digital interaction before a purchase.
But as viewership migrates heavily to premium connected TV, that logic just collapses.
Yeah, think about it. If you watch a highly produced, targeted video ad on a streaming app while sitting on your couch, you cannot physically click the television screen to buy the product.
No. You might pull out your phone 2 days later, run a search query, and buy it then.
Right. And under the legacy model, the search engine gets all the credit, and the CTV ad that generated the actual demand gets zero.
It is a systemic misallocation of credit that inherently biases corporate budgets away from streaming and towards search.
So to fix this, TTD is rolling out an alpha stage full funnel measurement framework. It is explicitly engineered to replace last click and track incrementality.
It uses identity graphs to connect the household that viewed the CTV ad on the television to the mobile device that eventually executed the purchase.
They're building the mathematical proof required to justify shifting budgets away from search and into the open internet.
And that transition leads directly into the broader competitive warfare. Every tool we have discussed, the Zuma usability overhaul, the Audience Unlimited subscription model, the full funnel measurement.
It's all a weapon forged for a very specific conflict. The trade desk is fighting a multi-front war against the big tech walled gardens.
Yeah, the primary existential threats to their market share are Google's buyer direct initiatives and the aggressive expansion of the Amazon DSP.
Let's define the battlefield here for you listening. A walled garden operates by bundling the entire ad tech stack. Google owns the ad exchange, they own the demand-side platform the advertiser uses to buy, and crucially, they own the media itself, YouTube and Google Search.
And Amazon owns the retail data, the buying platform, and the massive media inventory across Prime Video and Thursday Night Football.
They can undercut independent platforms on price because they capture the margin at every single stage of the transaction.
But the structural flaw in the walled garden model is an inherent conflict of interest.
Okay, expand on that.
When an advertiser utilizes a walled garden's buying platform to deploy capital across the broader internet, the underlying algorithm is mathematically incentivized to steer a disproportionate share of those dollars toward the walled garden's owned and operated properties.
Right. They're literally grading their own homework.
Exactly. While the trade desk's entire market position is predicated on structural buy-side objectivity.
Because they do not own any media. They do not own a streaming service or a search engine.
Their algorithmic mandate is aligned purely with the advertiser find the most efficient impression possible, regardless of who owns the digital real estate.
Okay, I understand the theory of buy-side objectivity.
Yeah.
It makes perfect logical sense. But let's look at the mechanical leverage for a second.
Okay.
Google is both TTD's biggest rival, historically one of the largest suppliers of inventory via their ad exchanges.
Yeah, that's the tension.
So how does an independent platform survive, let alone maintain competitive pricing, when the entity controlling the supply side of the pipes is actively trying to destroy them on the demand side?
Well, you survive by bypassing their pipes entirely.
Right. Open path.
Exactly, the mechanical function of OpenPath. Historically, the programmatic supply chain was cluttered with middlemen known as supply-side platforms, or SSPs.
Right. So the publishers say a major news website would use an SSP to auction their ad space.
And the trade desk, acting for the buyer, would plug into that SSP. The SSP extracts a take rate, a fee, from the transaction.
But OpenPath is TTD's direct supply pipeline. It integrates directly with the publisher's content management systems.
It cuts out the SSP middleman, removes the intermediary take rate, and allows TTD to bid directly on the inventory.
This structural efficiency is what allows them to remain cost competitive against the bundled pricing of the walled gardens.
And to bypass those walled gardens effectively, you have to secure access to the most premium, culturally relevant inventory available.
You cannot win the war if you only have access to remnant blog traffic. You need the SP500 Plus ecosystem.
And they are successfully aggregating that supply. I mean, they recently secured programmatic access to Netflix streaming inventory.
Which is just a massive validation of their CTV infrastructure.
Huge. They also secured integrations for Samsung ads, home screen placements.
Because securing the hardware interface is critical. By integrating with Samsung ads, TTD positions itself at the exact moment of user intent, before the user even opens an individual streaming application.
But the most formidable moat they are constructing outside the walled gardens is their dominance in retail media networks.
The retail data integration is brilliant because it directly attacks Amazon's core advantage.
Exactly. Amazon uses deterministic purchase data. They know exactly what you bought and when.
While Google relies heavily on search intent.
Right, so to compete, TTD is partnering with the entities that facilitate the vast majority of physical and digital commerce outside of Amazon.
They are now integrated across retail media networks that represent over 80% of top U.S. retail sales.
We are looking at massive data partnerships with Target, Costco, Kroger, and Albertsons.
And the absolute crown jewel of that retail strategy is the renewed multi-year partnership with Walmart DSP.
Yeah, and you have to understand, Walmart's off-site retail media offering is not a competing product. It is a white-labeled architecture built directly on top of The Trade Desk's APIs.
It allows a CPG advertiser to leverage Walmart's incredibly rich, deterministic shopper data to target consumers across the open internet using TTD's bidding infrastructure.
It is a symbiotic coalition that merges independent ad tech pipes with unparalleled retail intelligence.
But the strategy is clear. You build OpenPath to bypass the SSPs, you launch Audience Unlimited to eliminate data taxes, you upgrade the interface with Zuma, and you lock down the deterministic data of the American retail sector to fight Google and Amazon.
It's a solid strategy, but strategy is useless without execution.
Exactly. And a war requires generals who are fully aligned with the outcome. This brings us back to the leadership dynamics, the insider conviction, and the executive shakeup.
Right, which takes us back to the most glaring signal of insider conviction, which occurred in early March 2026.
Jeff Green's stock purchase.
CEO and founder Jeff Green executed an historic open market stock purchase. This was not a pre-scheduled 10b5-1 automated buy.
No, this was discretionary capital deployment. He utilized $148.1 million of his personal capital to acquire 6 million shares on the open market at a weighted average price of roughly $24.68.
It is an almost unprecedented display of founder conviction, especially for a company of this maturity.
He was aggressively signaling to Wall Street that the algorithmic fears surrounding AI disruption were fundamentally mispricing the core asset.
But the timing collided with the macroeconomic stall in the auto and CPG sectors.
Right, and because of the subsequent earnings miss and the violent valuation derating, that position is now deeply underwater.
Yeah, with shares currently trading around $13.40, that specific $148 million investment is sitting on an unrealized loss in excess of 45%.
The optics of a CEO absorbing a $60 million personal drawdown are intense, but it provides absolute validation that his incentives are tethered to the equity's recovery.
And while his conviction in the underlying architecture remains absolute, he clearly recognized that the operational execution was failing.
He responded by ruthlessly rebuilding the executive bench, bringing in heavy hitters to establish rigid operational discipline.
Let's profile this new executive roster because it tells you exactly what kind of enterprise they are trying to become.
Right. They onboarded Nate Olmstead as the new chief financial officer. His pedigree comes from Logitech and Hewlett-Packard Enterprise.
That is heavy, traditional tech hardware finance discipline.
You bring in an HPE veteran when you need to rigorously manage capital expenditures related to massive data center build-outs.
Exactly. They also appointed Christy Argilon as chief commercial officer, pulling her from her role as head of advertising at Uber.
And Uber's ad network is heavily reliant on hyperlocal, real-time demand, which maps perfectly to TTD's infrastructure goals.
Furthermore, they hired Ron Lamprecht as chief business development officer, poaching him directly from Amazon.
He intimately understands the mechanics of the walled garden they are trying to dismantle.
And perhaps most critically for the current macro crisis, they brought in Vinny Rinaldi as VP of Client Strategy and Growth, recruiting him straight from Hershey's.
Hiring an executive directly from Hershey's is just a surgical move.
Oh, absolutely.
If your biggest problem is that CPG giants are freezing their budgets and retreating to programmatic guaranteed, you hire a CPG insider who inherently understands the corporate psychology, the margin pressures, and the procurement logic of a Fortune 500 brand.
If we connect this to the bigger picture, the executive rebuild is a necessary maturation process. They're transitioning their corporate DNA from a scrappy software vendor selling to agency media buyers to a mature enterprise operation capable of negotiating directly with the C-suite of the SP 500.
However, Any objective evaluation of the leadership structure must also examine the governance constraints and the lingering legal overhangs.
Right, the dual-class voting
Yeah.
structure.
The trade desk operates under a dual-class structure where the Class B shares carry 10 votes per share and are heavily concentrated among Jeff Green, the directors, and early insiders.
Currently, the structure grants them 50.3% of the total voting power.
Mechanically, that means activist investors have zero leverage. You cannot launch a proxy fight.
You cannot force a hostile takeover or demand a board seat to agitate for immediate cost-cutting.
The insiders retain absolute control over corporate governance through December 2035, when the Class B shares are scheduled to automatically convert to Class A.
It provides management with the insulation necessary to execute a multi-year infrastructure transition without answering to quarter-to-quarter activist demands.
But it entirely removes the mechanism for shareholder recourse.
And that lack of recourse makes the ongoing legal battles highly relevant to the institutional risk profile.
We have to impartially report the facts regarding the litigation docket. There is an active, consolidated federal securities class action lawsuit progressing in the Central District of California.
The plaintiffs are alleging false and misleading statements and insider trading claims covering the period between November 2023 and August 2025.
The court denied the defendant's motion to dismiss back in March 2026, and a hard trial date is now set for May 16, 2028.
And beyond the securities class action, there are also derivative lawsuits challenging the board's decision to reincorporate the company from Delaware to Nevada.
With plaintiffs alleging breaches of fiduciary duty. Now, regardless of the ultimate legal merits of these claims, an active securities fraud trial set for 2028 acts as a persistent anchor on institutional sentiment.
Compliance departments at major funds often restrict capital deployment into equities with unresolved federal securities litigation.
It introduces an unquantifiable variable into the risk matrix, which brings us to the ultimate synthesis of the data.
We have audited the top-line deceleration driven by the macro environment.
We have deconstructed the margin compression caused by the data center build-outs and the accounting tax detriments.
We've analyzed the strategic pivot of Zuma and Audience Unlimited, the walled garden warfare, and the heavily centralized leadership structure.
Now we have to reconcile the valuation. The market has violently stripped away the hypergrowth premium. The stock has collapsed from a 52-week high of $56.77 down to the $13.40 range.
An enterprise that routinely traded at astronomical multiples is now sitting at an enterprise value of approximately 1.7 times sales and roughly 5.9 times forward-adjusted EBITDA.
So I pose the ultimate question, based on the evidence. Does this current valuation reflect a fundamentally broken company? Or are we looking at a highly asymmetric turnaround opportunity?
The evidence strongly suggests the foundational mechanics of the platform remain entirely intact.
The hypergrowth narrative fractured, but the operational floor is remarkably resilient. Let's look at the cash mechanics.
Right. Despite the revenue stall and the massive infrastructure expenditures, the trade desk generated $136 million in free cash flow in the second quarter.
That is a 17% year-over-year increase in actual cash generation from operations net of capital expenditures.
They are printing cash in the middle of a massive deceleration, and they are not hoarding it.
They deployed $78 million during the quarter to repurchase and retire 3 million shares, actively reducing the float at these depressed valuation levels.
But the most compelling metric pointing toward a structural turnaround is the acceleration within their joint business plans.
Joint business plans, or JBPs. They are the critical forward-looking indicator for enterprise ad tech.
Because the trade desk does not force advertisers to sign rigid, multi-year minimum spend contracts.
Therefore, they lack traditional binding backlog revenue. Instead, they utilize JBPs to map out annual strategic media commitments with major brands.
And in Q2, their active JBP has expanded 38% year over year, reaching 217 core clients.
And crucially, the revenue flowing through those JBPs is compounding at 6 times the rate of the overall company revenue.
That is the definitive proof that the platform is not broken.
The most sophisticated, high-volume clients are deepening their integration and committing more heavily to the ecosystem, even as the broader macro environment forces smaller or more exposed advertisers to pause.
But a turnaround is never guaranteed. There are 3 explicit execution risks that management must flawlessly navigate over the next 12 months.
Let's lay them out. Risk number 1 is the persistence of the macro budget pauses.
Right. If the geopolitical volatility sustains commodity inflation, or if the consumer wealth bifurcation deepens, the budget freezes in the CPG and automotive sectors could calcify into a permanent structural reality rather than a cyclical pause.
Risk number 2 is take rate compression.
If Google and Amazon aggressively leverage their balance sheets to subsidize their ad platforms, bundling their owned media at predatory discounts, independent DSPs like TTD might be forced into a margin-compressing price war to defend market share.
And risk number 3 is adoption friction. The entire thesis for re-accelerating growth hinges on the successful, widespread adoption of the Zuma platform upgrade and the audience unlimited data model.
If agency buyers find Zuma just as convoluted as Kokai, or if advertisers refuse to transition to the subscription data model, the internal friction remains.
And the revenue engine will stay stalled at the 3% mark.
Management has the cash, they have the retail partnerships, and they have the direct supply pipes. Now they just have to execute.
They're enduring a painful transition. The market is forcing them to mature from a growth-at-all-costs darling into a highly disciplined, cash-generative value play.
And if they successfully execute this pivot, the underlying operating leverage built into those owned data centers will produce formidable cash flows.
So what does this all mean? We've analyzed the macro cycles, the data center economics, the GAAP accounting adjustments, and the competitive warfare.
It's been a lot of ground to cover.
But I want to leave you, the listener, with one final, provocative thought to mull over. It goes beyond the immediate quarterly headwinds and strikes at the underlying premise of the entire digital advertising ecosystem.
The open web itself.
Exactly. The Trade Desk's entire business model, their entire reason for existing, relies on a thriving, decentralized open web.
They need independent publishers, vibrant blogs, niche news sites, and sprawling streaming platforms for consumers to visit and consequently see ads.
But consider the rapid evolution of generative AI and large language models.
Oh, this is the real existential threat.
It is. If these AI interfaces fundamentally change how consumers browse the internet, if you simply ask an AI a question, and it provides a direct, synthesized answer in a chat window, eliminating the need for you to click through 5 different independent websites to find the information yourself.
Will the total addressable inventory pool of the open internet begin to permanently shrink?
It is a profound structural question. Because if the traffic to independent websites evaporates because AI aggregates the answers, the volume of available ad impressions on the open web collapses.
And if the open web shrinks, the sandbox that the Trade Desk plays in shrinks right along with it.
That is the true existential question they will have to answer, not just in the next earnings cycle, but in the decade to come.
Something for everyone listening to really think about.
Absolutely. Thank you for joining us on this deep dive into TTD. Keep questioning, keep digging, and we will catch you next time.